Guys, Alibaba is crushing it. Year to date, it is up 93%. This was a company that not too long ago was sitting around $60, $70, $80 a share, and people were saying, oh my God, Paul, you don't get it. You're such an idiot. China's communist. They suck. Guys, I'm not declaring victory yet. This is a short-term growth in the stock, 93%. But guess what? There's a lot of potential for Alibaba. I truly believe that the largest company in the world's fastest growing large economy, which will overtake the US, and that's okay, has amazing potential. What I don't want you to do is sleeping on it because you read the media out there. At first, it was issues like ADRs, which is these stocks that aren't really owned or don't really own the company. They just have access to the cash flow. And people said, that's the reason. I'm like, really? Because if you look at it, it was the same reason all along the way here, but nobody seemed to care about it there. And all of a sudden here, people cared about it a ton. Maybe. And then it's the war against China versus Taiwan potentially happening. Okay. These are all legitimate concerns to think about. The question is, are they exaggerated? And is it news following the stock price? Was it happening because the stock was like this? I want you to remember that if you're new to this channel, Everything Money Plus. We want you to start thinking like an independent investor. What I don't want you doing is buying a company because somebody on the internet has it. That's the last thing I want you doing. I want you to learn a process. Whether you apply it to Baba or Microsoft or NVIDIA or any number of companies, value investors think the same way. They just want to buy something when price is lower than value. And for Alibaba, at 164, it's a very different story than when it was at 58 bucks. That's the first lesson I want you learning. 58 and 164 changes the entire investment thesis on a company. This is almost 3 times higher than its low. That's what's key here. You can't forget that. The stock is up a lot recently. Is it going to be up forever? I don't know. Could very well go back down to 60. We have no idea. The future is unknown. But what I do believe is I think about these companies and say, okay, Alibaba, is it going to be around for a long time? I think so. 20, 30 years. Okay, in that time, is the revenue and profit going to be up and higher than it is today? Probably. Very likely. Why? Because China is it's a fast-growing economy. Their recessions are still growing economies. They've got 1.6 billion people. Yes, it's declining. It declined last year and likely to continue. But if it doesn't, it becomes the forefront of the next economy, then it might start growing again with people. And guess what? The average person in China still makes less than $15,000 per year. What do we make in the US? 70, 80,000 a year. There's a big growth potential for China. Alibaba will be a great recipient of that. Let's check out the 8 pillars on Alibaba. Here's what's interesting. It's shit. 5 X's, 3 checks. One thing I love is they're buying back shares at cheap prices. That's what I love. This is smart allocation of capital. Guys, buying back shares is only a good thing if you're buying back cheap shares. When I see these companies selling for 50, 60, 70 times earnings, buying back shares, I think, oh boy. Now keep in mind, that doesn't mean that they're overpriced because they're selling for 50, 60, 70 times earnings. But if it's a multi-trillion-dollar company, it likely is overpriced at those kind of multiples. But Alibaba here is sitting at a $400 billion market cap. Guys, go back and look at our videos. I remember when it was 180. Yeah, it wasn't very long ago. Low debt, revenue growth, net income, free cash flow are down a lot. But let's go check out these financial statements. Their capital expenditures have jumped up. They're at $12 billion in capital expenditures. Look at their operating income. 8 billion, 11.5, 17.5, 21, 25, 33, 20, 28, 25, 23. It's declining as of late, but still higher than it was 10 years ago. Now, again, do I think Alibaba is going to be here for the long haul? I do. Let's see what the analysts think about it. They have growth in their profit. And by the way, this has gotten way better. It looked way worse before. Why? Maybe they're onto something now. Maybe they realize that, they might have been too negative on Alibaba. I have no idea. Revenue growth, though, mid to high single digits. Nothing to write home about. But let's look at our stock analyzer tool, because what's really important here is to sit there and understand, is this a good price for the company? Because it's up a lot. And people grab attention to that and say, I don't want to miss out on that. But as an investor, your job is to buy a good company at a great price, a great company at a great price. And if you were interested at 58, then maybe it's not as interesting now, but you still have to do the math. If you're interested at 300, why are you not interested at 165? Why were you not interested at 60? Then that's becoming more about speculation. And guys, before this video is done, I want to show you where I think the market actually is in terms of market value. But right now, I'm looking at a 10-year analysis. I did 3, 6, and 9% revenue growth. Nothing huge. Profit margin, 12, 15, and 18. And I did a higher free cash flow margin because in the last 5 and 10 years, they did more free cash flow than net income. And PE, I did 14, 18, and 22. Same with price of free cash flow. And guys, finally, my desired return of 9%. This is the market return, 9 or 10%. This does not mean it's the price I'm buying the stock at. You have to have margin of safety when you buy individual stocks, especially ones overseas that you don't understand their economy and there's more risk to it. I fully acknowledge there's probably more geopolitical risk to Alibaba than there is to Microsoft. So you got to put margin of safety in there by making a higher desired return. The stock's currently at 164. Hit the analyze button. All right. I have a low price of 100 to 130, high price of 330 to 380, middle price of 190 to 220. Based on a discounted cash flow model, if you pay 164 today and my middle assumptions occur, you still have 13.5% return on your stock, if it still makes sense at that price. But again, don't just do it because I own it or anybody else does. Apply the things we're teaching to look at it in your own way. That's how you'll do the best. Now, in terms of the market in general, guys, stock market's been ripping again. April 8th to now, it is absolutely up huge. And look how much. I mean, look at this, guys. March 31st, the S&P was at 5,600. Now it's at 6,600. It's 122% overvalued. Now, you might sit there and say, Paul, stock market GDP doesn't matter because so many companies make money overseas, blah, 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 blah. Shut up. Sorry, just shut up. It's dumb. You're just justifying higher valuations. And guess what? When stocks are 50% overvalued or more, the next 10-year returns without dividends is negative 2.3. That's only on 50%. We're 122%. Could it be different this time? Yes, it could be. If all of a sudden the world is going to go break out into some massive growth that really affected U.S. companies, but how much growth does it need to be? Probably far more than could actually happen. And for those of you who do say the stock market GDP doesn't matter anymore, okay, let's go to the 10-year PE ratio. It's worse. It doesn't care where the money is earned, internationally or local. It's 125% overvalued. It's worse. We're almost at 40 again. We're at 39.95. It was at 44 during the dot-com bubble. 44. So guys, what am I trying to get accomplished here? I'm not trying to be a futster. What I'm trying to do is tell you, guys, China and Alibaba were shat on just a year, 2, 3 years ago. But if you had the balls to sit there and say, hey, I kind of like it. A few value investors started buying it under 100. I started buying it under 150 and bought it all the way down. Now, am I happy with it? Yeah, but I still think it has more potential, so I'm not going to sell it. And I don't need to sell it. That's my opinion. But again, don't emulate me. You don't know my financial situation in full. I don't know yours. We're trying to teach a process of how to think about companies. If you're at that point where you're buying individual stocks and you want to think differently, very easy solution for you. Join our community. You get all of these tools. You get the community. You get the stock analyzer tool. This thing alone gets used over 1 million times per year by a few thousand people. Why? Because it changes the way in which you look at money. It applies the numbers to the story. Because if you're just buying on a story, you're not investing. But if you're watching this video this far, it means you're more of an investor. And I want you in the community. But I want you if you're serious. That's it. If you're not serious, if you want to just steal ideas from people and never do your work, it's going to go poorly for you. Stay out of there. But if you're really serious about upping your investment game, becoming smarter and becoming better, this is the place for you. Click the link below, 7-day trial. I assure you, you're going to see value in it. Thank you for your time.